Thank you everyone for being able to come today for our webinar, Engineering Your Wealth, Discovering the Engineer's Edge in the Real Estate Arena. I'm leading this webinar with my founders and teammates, myself, the Kembang CEO and co-founder of Event, co-founder of Opportunity Partners. Also have Brandon King, who's the director of acquisitions, and Collins Kembang, who is the director of operations. Really, reason why we started Opportunity Partners is to be able to educate individuals on the benefits of investing in real estate, specifically commercial real estate and multifamily. Because as engineers ourselves and EV professionals, we've seen that many people do not know about the opportunities that are outside of the stock market and different alternative investment needs. We actually have the goal to help that. We have the goal to help 1,000 engineers and building professionals invest passively in commercial real estate by 2030. And the way to do that, step one is education. So we're glad that you're here today. And I hope that all of you can be able to learn something today, potentially go on and begin your investment career, invest with us potentially, and just continue being involved with our community and be educated. Because I genuinely believe that there is more to life than solely your working your 9 to 5. There's so many more things that you can do as well to give you more time and continue reaching towards your success. So with that, we have our two panelists here, Sandhya and TJ Burns. I would love if you could introduce yourselves, and then from there our we get into some of the questions that he has, and from there it will be open Q&A.
I can go first. I'm Sandhya Seshadri, and I'm based in Dallas, Fort Worth. Electrical engineer by profession, worked for a while at Texas Instruments based in Dallas, and also invested heavily into the stock market. And of course, all of us put our 401ks into the stock market. We don't have any other choice. But once you're out of a previous job, that's where you could put it into real estate. And so now I'm a full-time apartment investor, and all my deals are in the Dallas-Fort Worth area. I invest passively with my retirement money, and then I invest actively to be a qualified real estate professional to manage my assets. So I'm into underwriting, acquisitions, operations, capital raising, the whole shebang. And I post a lot on LinkedIn and Facebook if you want to connect with me there, to be careful in your scrutiny before getting into investments. Thank you for the opportunity.
Awesome. My name's TJ. I am mechanical by trade. I graduated college about 7 years ago and landed what I thought was my dream job. Went right into working in product design at a startup that we got acquired by Amazon. But I realized pretty quickly that I didn't want to do that for the rest of my life. That I probably wanted to work on business at some point. I wanted to have a little bit more freedom than going to the same desk every day. So initially just started learning about all different types of investments and eventually honed in on real estate as being the one that could get me there the fastest. So did a number of different things to start. I was kind of all over the place, single family homes, multifamily. And I actually found a wallet on the street that led me to what I'm doing today. So found a wallet of becoming an operator, was able to partner with that individual on 2 deals and found a lot of success in that, and made a number of limited partner investments. After that, learned a whole bunch about that business, found that it really went well with my engineering career. And then from there, I realized that I actually really loved real estate and I could add a lot of value to my network. So I built a business around that. And today I focus primarily on raising money from people in tech that want to invest in real estate. To date, I've raised about $3 million spread out across 4 to 5 different projects, and have just continued to learn and get better at what I do ever since. So Thanks for having me. Looking forward to the discussion.
Hey, Alvin, I would love if you can give us a little introduction about yourself, man.
I
What
think
brought
he's
you?
muted. You have to
Hello,
unmute yourself.
hello, hello. Y'all can hear me? Okay, perfect. Good to see everyone. Glad to be on. So my journey is very diverse. Been in a lot of different industries. Initially, right out of college, I did physics and math and studied. Played football. Was an All American and Hall of Fame athlete, and eventually went into play with the NFL right after college. So was with the Chargers. I'm originally from Louisiana, played college ball in Carolina, South Carolina, and then went to California, played football for a while, for a couple of years, and tore my ACL, had knee surgery, meniscus, also had shoulder surgery before that. So my career kind of shifted. I needed to transition. I needed to figure out something else. I mentioned, studied physics in undergrad, so I went got my master's in engineering, mechanical engineering, and worked as an aerospace engineer for about 7 years, and was investing in real estate on the side. My parents have a portfolio back home in Louisiana as well. So, a lot of asset management and property management was what I grew up around. So I knew real estate was the way, right? So I was investing passively while working as an aerospace engineer until just earlier this year, retired from aerospace engineering altogether. The real estate income was pretty much superseding the engineering income, and I'm putting maybe 1/5 of the time in. So once it gets to that point, it's a tale that you need to make a transition. And currently now working as a managing partner of Financial Athlete Capital and Imperial Fortune, basically working with athletes, current and former athletes, on different ways they can strategically invest and place their capital in real estate. And also as a former engineer, working with a lot of professionals on the technical side as well.
Great. Awesome. Thanks you all for the wonderful introduction. And hey, let's get right into it. I would, so starting with Sandhya, I would love to know, how did you address any initial fears or limiting beliefs when you started your investment journey?
So I use the analogy of flying on a plane. And first, I like to be a passenger before I become a pilot. So the passenger is the passive investing side. And I overcame that big barrier of, wiring $50,000 to somebody's investment by getting to know the person. I visited the asset. I knew the syndication attorney and the title, etc. So that was part of the list to vet them. And lastly, I used retirement money from my prior employer. So that's money I'm not counting on at least for a decade. So it's not like, oh, my family is going to be impacted if this deal doesn't do well or doesn't cash flow. It's money I wasn't planning on using for at least a decade, if not longer. So that helped me get over the hump to invest passively. The active side came from having invested passively, like being a passenger on a plane, knowing what is turbulence, experiencing the ride, and then being a which is joining up with somebody else who has more experience. And when COVID hit, that's when I got my deal. It's 2019, and then 2020 COVID hit. I ended up doing a lot of the work because my partners were from out of state, and that helped me get over the hump because I learned all of it from soup to nuts from having to do that. So that's why I do both passive and active investments today. That's the right blend for me.
Hey, Alvin, it seems like you have things to say too.
Yeah, on repeat the question one more time.
So how did you address any initial fears or limiting beliefs when you started your investment journey?
I would say definitely what Sonia mentioned. That's a great start. I would say for me, everything that I do, I always have a mentor or a coach or an advisor in that area. It can be somebody that somebody that you just met, whoever, to make sure whenever you making decisions starting out, that you're using their 10, 20, 30 years of experience as leverage. So uh, whether I'm doing investments, whether I'm doing real estate, or I'm whatever I'm doing, I make sure I have somebody that I can bounce questions off of, get feedback from. So even though I might have 0 years of experience or 1 year of experience in doing something, I'm not making decisions as though I'm a 0 or 1 year experienced person, because I'm using their experience to my benefit. So, I always highly suggest, make sure you have someone that's more experienced than you that you can bounce ideas off of and use their expertise to grow your expertise, right? Because you look at it, as you grow, as you get to that 10, 20, 30 years mark, you've been working on that since year zero, right? So now you're at an exponential growth as you progress along in your journey.
TJ, for you, the question I have for you specifically is you being the sole person on the panel who is currently still working as an engineer. How, and many of the people within our audience are also working. For example, even myself. How do you balance your demanding career in engineering with the time and energy required for real estate investing?
Yeah, I drown mostly, but on my best, it's all about slow, consistent growth for me. I'm just trying to make progress every single day. And a lot of the investors I talk with, um, whether they're active or passive, um, really mostly like the beginner investors, people that haven't got started. The thing that pulls them back, I think, is just not consistent. Because if you know where you're trying to go and you just take one step every single day towards that goal, you're going to get there eventually. And I think a lot of people, they know what they need to do. All the information's out there online, on YouTube, you see it on LinkedIn, but most people don't take that action every single day. And for me, it's hard, right? I mean, I work full time. I got a family. I got a kid. I'm building this business. Um, I think the passion that I have for real estate is really helpful. If you don't have passion for what you're doing, it makes it really hard to get up and do it every single day. So the people that have the staying power are the ones that really love what they do. And for me, I found that building a business in real estate is that. Um, and then like Alvin and Sandy mentioned, partnerships are huge. Like I don't try to do everything in real estate, and I don't pretend to know everything in real estate. I just try to go very deep and specific on the things that I can add value to other people with. Um, And I let the other people that I trust and that I want to partner with, who are great at what they do, I let them own that. And that was one of my big mistakes starting out, is I thought I had to do everything. And I thought that if I did everything, that I would have a bigger piece of the pie. I would have more money and build a business faster. Completely the opposite. You have to give up some control in order to make progress. And the best way that I was going to do that is to bring value to other people, create a partnership with them, and then leverage each other's strengths.
And you mentioned something very interesting about the active investing and passive investing. I would love if you could give a little bit more insights into that. Because take, for example, I'm a busy professional. I'm doing well in my career. I want to diversify into real estate, but I don't want to be a landlord and deal with tenants, toilets, and trash. So I'd love if you can give a little bit of insight on that.
Want me to go first, right? Or who would you like to?
Hey, Sandhya, no problem.
Okay. I'll let somebody else go first next time. So on the passive side, it's like the analogy I used for a plane. So you're a passenger in a plane. You don't have to worry about the turbulence, navigating through, rough terrain, etc. It's all done by the pilot. So you sit back, relax, and enjoy the ride. Once you figure out and you buy your airline ticket, you know your destination, you know your route, you pick your airline, etc. So that's nice because you don't get the day-to-day hassles and liabilities associated with the landlord. You don't have to deal with lenders. You don't have to deal with signing loans. You won't be liable if something isn't paid. Tenants can't sue you. You're protected from all of that work and liability if you're a passive investor, which is why I still invest passively. On the active side, it means you're doing the work. And I do syndications. So in that case, other people are trusting you with their hard-earned money. And you can't explain it away like a mutual fund manager who says, oh, the stock market crashed. Well, too bad. You don't have a general excuse like that. You're like, what did you do with this property? Why isn't it, operating well? Why aren't you cash flowing to investors? So you have a fiduciary responsibility to execute the business plan and return money to investors. So it's a lot of work. And you've got to navigate through whatever happens, like insurance goes up, taxes, there's floods, there's storm damage, all of those have. So we hire third-party property management companies to do that, but it's a good blend to do a little of both for me because it takes a lot of time to do that work. If you have to manage your asset, operate it, and return money to investors. So you really have to think, if you're a busy professional, about how much time you have available and whether you want those assets.
Yeah, I would definitely agree. I mean, so the everyone has a limited resource of time, right? There's only so many active investing that you can do, and then as Sandhya mentioned, managing other people's capital and money is a really huge responsibility. I would not invest in anyone that really doesn't understand that from a general partner or a sponsor standpoint. So you can always scale more as a limited partner, passive investor. I also invest passively in my own deals and others' deals. So I would say build up your understanding from a passive position, and then maybe you can invest as an active investor to partner and collaborate on more future deals as you become more experienced, especially if you're working a W-2. It's pretty much it is very, very hard to be in the day-to-day operations if you have a 40 plus hour a week W-2. So
Actually, for TJ specifically, you talked a lot about the active investing and passive investing. So you've mentioned that you also invested passively. And for example, Sandhya talked about being able to invest passively, leveraging your retirement accounts. So for you, where did you source the capital for your first investment? And what advice do you have for newcomers regarding funding?
Yeah, I think retirement accounts are a great route, especially if you're an active investor and you have retirement funds that you want to put in real estate, because you can't invest those funds into your own active ventures. You have to go and invest them into somebody else's ventures. So I've had investors before that they are active and they crush it, but they invest their 401k funds with people like me because it's a way for them to diversify outside of themselves. They have to, um, they can now form a relationship with somebody else. I think for sourcing your capital, you got to work with what you got. In my case, um, I started a startup. It got acquired by Amazon. I started working at Amazon as like a mid-level engineer, and I was able to take the Amazon stock I had and just repurpose it um, into LP investments. And that's what I did. My wife and I, right? And I guess, like, to dig into that a little bit more, it really comes down to the basis of personal finance. You gotta create a spread between what you're earning and, uh, and what you spend. And then you take that's your savings, and you go and deploy it. And the more aggressive you can be with that capital, the farther it's going to take you, right? Especially if you're younger, you're just starting out, you don't have as many responsibilities in your life. When I started investing, I was 5, I wasn't married, and I was a child. And that's not an excuse for people that are later in life. It's just, you got to work maybe a little bit harder and be a little bit smarter. Um, so, so yeah, work with what you got. If you have retirement funds, use that. If you get stock grants, repurpose those. You're just working off your salary, put together a budget and funnel that money into an account. If you only have 25,000 and the minimum is 50,000, just ask the operator if you can invest a little bit less, and they'll probably allow you to do that, right? Um, and if it's not money for you, if you have some other way you can add some value, then That's what you have to do. You have to just continually ask yourself, how am I going to add value to this person? Because the people that you want to be working with, they're so busy right now that it doesn't help that I actually come to them and say, hey, I want to work for you. Like, what can I do? Because then they got to think of things for you. Or it's much better for you to show up and say, hey, I noticed you have this going on and I have a solution to that. And by the way, I already did it for you. It's done. And if you ever need anything, call me again, stuff like that. Right. And you wouldn't believe how far that stuff would take you because nobody's doing it. Most people are, hey, can I get 20 minutes of your time or things like that. Right. Um, so yeah, I guess add value, work what you got, and and, and keep moving forward.
How this question is maybe that really touches home for me because I was actually affected by this as well. Um, with the current volatility in the tech and engineering job market, including widespread layoffs, many professionals are feeling very uncertain about their career stability. So I'm curious, how has diversifying into real estate helped you mitigate these concerns? And what advice would you give to some of the other professionals who are looking to real estate as a means to secure their financial future amidst such job market fluctuations? And I know that we're going to start with Sandhya, but I want to start with Sandhya on this one because I know that you personally were
Mhm.
affected by this years ago.
Yes, I will go first on this one, but for sure somebody else next time. The biggest starting place is figure out whatever is your basic household budget. I don't mean like the country club memberships and first class tickets kind of lifestyle, but I mean the very basics, right? What do you need to still live under the same roof, whatever that is, including basics like, yes, you need a phone and yes, you need some kind of a basic car, etc. What is that number? Is that 5,000 a month? Is that 10,000 a month, etc.? Figure out what that number is, and then say, okay, if you get laid off, how much do you have in your savings built up and other forms of income? So then you have a gap. Let's say you have $3,000 a month that you have even without your W-2, but you really need to get to say $10,000. Then that gap is $7,000. So what are some other sources can slowly start generating that money so that you can close that $7,000 gap over a period of time? It's not going to happen overnight, but maybe you can find a couple of additional dividend stocks or real estate that could start adding up by a few $100s a month. The second place I would look at is some of us, at least in our W-2 days, automatically put a certain percentage of our income into company stocks as part of our 401k matching funds, etc. So I always say, do it up to the company matches it, but the rest of the money, does it really have to go into your company's 401k where it ends up being like some kind of a target fund, 2030, 2050 retirement fund kind of stuff? And you have no idea what's the mix of stocks for that. You don't know what the fee structure is. And it's like this big black box. Instead, invest up to whatever your company matches, take the rest of it and put it elsewhere where you have more control, whether that is an IRA for stocks or a Roth IRA, a self-directed IRA for things like real estate, and then have a specific plan and you monitor that quarterly so that you can then figure out when can I be independent of my W-2, at least to cover my basic expenses. And that's, in my opinion, the first level of financial freedom.
Yeah, TJ, I'd love to hear your insight as someone who's currently working.
Yeah. So, I think for a lot of my investors, it's about diversification. You take like the Amazon employee, that person, not only do they work at Amazon and that is their W-2 job. So if Amazon goes through tough times, they might get laid off. But they're also paid at Amazon stock. Probably 40% of their salaries in Amazon. And then if they're investing solely in the stock market, well, Amazon is factored into that too in a pretty large way, right? So there's three ways that person is not diversified, that they kind of have all their eggs in one basket or a very similar basket. So real estate just from the jump is it's a great way to diversify outside of for like the typical tech employee. And like we've talked about, a lot of tech employees don't know that they can invest in this. Um, as far as building, your safety net so that you don't feel as stressed if you get laid off or you have alternate income streams. I think my advice it just goes back to being consistent. So when I got started, $10,000 a month in passive income, it could have been like the boogeyman. It was so far away from me. I didn't know how I was going to put that together. It's just completely impossible. But what nobody told me was, well, if you have $1,000 a month in passive income, that actually makes a pretty big difference for most. That's maybe it pays off, the two spouses' car payments per month. Maybe it helps with the childcare expense. That's your budget. So your goals don't have to be super big to start. It could just get to $300 a month, get to $500 a month. And that will be enough to help you to see that, wow, this actually is beneficial. And what I noticed for me with Amazon was, the more I moved towards that goal that I had of more passive income, more wealth, the less stressed I was about being laid off at Amazon, about worrying about, policies like return to office. Um, and that's really nice. It allows me to focus my energy on my family, on my business. I'm not worried about all the gossip that's going on and all the hierarchy stuff and positioning myself to get promoted. I don't care about any of that. I mean, it helps me to just do it when I'm, do my normal job, put some hours in during the day, work on my business, family. It really opens up options.
Yeah,
And
no, yeah. Oh, Alvin, please feel free.
I was gonna say options are huge. Like that like stress, freedom, the ability, just to ease your mind. That's the biggest leverage you have in life. Options. So I want to say real quick on the diversification component. A lot of people think that your diversification is diversifying in the stock market. That and that's not diversification. It's really diversification across asset classes. So alternatives included, right? But a lot of most financial advisors not going to advise real estate because they don't get paid from that, right? So you really have to study the wealthy. That's the way I break it down is what is the asset allocation of the wealthy, the 10%, the one percenters, and versus the asset allocation of everybody else. And you'll start to notice some trends and some clear distinctions between the two. All right. So to alleviate a lot of the fluctuation within the stock market, real estate, one of the most stable asset classes you can invest in. As a reason that 90% of millionaires come from real estate, just because it's guaranteed to grow up. Appreciation actually helps the value of your real estate, whereas your stock market, your stock market portfolio, inflation actually helps real estate go up, whereas inflation is not necessarily on your side from a buying power standpoint within the stock market. So just little components like that you really want to be aware of. Of course, there's appreciation and dividend where you can make money in the stock market, whereas in real estate, there's 7+ ways you can make money in real estate from a tax perspective, from a appreciation and cash flow perspective, and so on and so forth. So those are the diversification and benefits that are accessible to you when you diversify into the alternative investment class.
And no, for me personally, actually, I was laid off from my job about 5 months ago. And fortunately, although I was not getting income from my job during this time, my basic expenses were covered from my real estate investments. And it's at that point where you're able to really see kind of where those benefits are, right? And like now, as I actually just secured a new role, but during this time, I've been able to, rather than kind of being extremely worried and just hopping into the fastest job that I can get because I need to rush and pay my bills, it allowed me to have more flexibility and comfort and take the time to do exactly what it is that I want to do. Right. So just like me personally, I've been able to see that benefits of kind of that diversification because, hey, especially with the market that we're in, odds come and go. Like people are getting laid off every single second. Like literally, personally, my cousin last year started a new job, was there for 2 months, got laid off. Found a new job, was there for 11 months, and was recently just laid off. So it's the type of thing where it's there's quote unquote no loyalty. Like you are about yourself, you have to be carrying yourself. That's something that really, for me personally, is something that I resonate with. So now, for Alvin, specifically for you, how did you transition from your diverse careers, being in the NFL and then engineering and then now real estate? What was really that first investment like?
So going back to the last topic, options. You got to have options. That's what really allowed me to maneuver and excel within very different industries. I would say on from that first investment, you always want to start off with a simple understanding of self belief and confidence, right? I would say fear probably stops most people from doing most things than any other aspect or component in life. So just I always say, do your homework before you go out and play, which basically means just do some research, read some books, connect with some people so that you can talk the language, and confidence will breed that comfort and the ability to perform and eliminate fear. So, that's probably step and component number one. And then from there, it's just a matter of getting the reps in, just going out there and showcasing. Of course, there will be hiccups. There will be some, everything won't be smooth all the time. But the more you can get those reps in, obviously, I watched the video was talking about just how difficult things may be. At some point, you didn't know how to walk. You realized you were just crawling all over the floor. Like, you couldn't even put your left foot in front of your right foot. Like that's how bad you were. Hey, but you learn how to walk, and then at some point you realize you didn't know a word. Like you couldn't even put two letters together. You couldn't simple speaking. You had no idea what to do. But that's just part of life. So uh, put getting those reps in, practicing, you will get better with time, as you have done in every other aspect of your life. It's okay.
No, specifically, so I'm very curious, Sandhya, what was the turning point that led you from that stable
Mhm.
corporate job to now being within the world of real estate investing?
So between the corporate job and real investing, I was very heavily into the stock market, but I realized I wanted something to diversify and something that gave me tax advantages. And those two drew me to real estate. But the minute I analyzed something that was single family, I didn't see sufficient returns in the Dallas market in terms of appreciation or in terms of cash flow to justify signing a recourse loan, meaning if I can't pay the loan, the bank can come after my personal assets. But in large multifamily, I never knew that somebody like me, an ordinary person, engineer, could go and buy a $20 million building down the street, right? And that's possible through syndication. So I attended a weekend event that helped me understand syndications, started passively, and then went on to the active side. That's my path.
So when you say you attended this weekend event, started passively and then ended up being actively, I know from my understanding you initially, I think you were working at Texas Instruments for quite a long time. It seemed like you had
Right.
a successful career, traveling everywhere, handling a very large budget. So many people would say that's the dream.
It is.
That's the dream. So how could you just decide that, you know what? I could do something else.
Well, I saw what we paid in taxes. My husband also had a W-2. He's also an engineer and worked for the same company. We saw our tax bill every year and we were like, okay, we got to do something different. So that was one big reason. And then the second reason is that I wanted to be able to choose my hours of work. and eventually get to the stage of work optional because we're not lavish spenders. We don't actually fly first class or Ferraris or anything like that. So it's like, okay, I don't need the job, but what can I do? Because I've got, my engineering brain, and I've got to find something to lower my tax burden. That's what led me to real estate. I think it's the most classic thing that we've known for all our lives. All of us rent a place before we buy our own place. Real estate is just so, I guess, basic and fundamental human need. I wasn't going to go start a restaurant. That's another headache, business, etc. It seemed obvious, but to get over the hump, it's like, I don't want to be doing the tenants, toilets, trash, etc. of a single family. And I wasn't experienced in fixing leaky toilets, etc. on Thanksgiving Day coming up next week wasn't, my cup of tea. So I was like, okay, I need to find a way. So large apartments, what it does for us is we employ third-party property management companies with full-time personnel on site. And that's what made it attractive.
So now, TJ specifically, for someone who is looking to begin investing, that's looking to invest passively, ideally, what amount of capital would they need? And also, is from your experience in a deal that goes well, what type of returns would be expected?
Yeah, return, it's all over the place. It really depends upon what market you're in, what asset class you're in. You have everything from new development to a stabilized multifamily deal, all sorts of other things. I'm sure everybody on this call has heard of mobile home parks and self-storage facilities, all these other types of assets that fit into the world of real estate. So it's really all over the place, especially right now when we're in this market of a little bit of like price discovery. I think over the last couple of years, we'll have advertised returns in like the high teens, low 20s, and this is not where we're at right now. It'd be really hard to give you an idea of what your returns are. For me, I'm investing in things where I feel like right now we're going to consistently, bring in somewhere between 12 to 16%. But I've also been looking more into like debt lately, which right now debt from like a risk standpoint or from a return standpoint, it's a little bit more attractive than some of the equity deals that I've seen. So that's the return side. In terms of capital, usually it takes like $50,000 per deal to make it really worth it for you as an investor, because there's a little bit of extra work. One, I always tell my investors, you really need to have like a base level of education before you go into a situation. I don't want you to just blindly put your money into this deal. I know we have a level of trust, but I want you to go and educate yourself. This is a great asset class. It's how I invest, but it's a little bit more involved than just buying an index, right? I would say though, like you can start out with 25,000, especially in a career like engineering. If you're looking at your career and you're anticipating that you're gonna increase your salary every year, you're gonna move up, you're gonna get to a point where you can invest, $50,000 per deal. Then it's never too early to start building relationships with sponsors. And one of the best ways to do that is to approach them and say, hey, I like what you're doing. I saw all these things that you posted. Would you accept an investment of 25,000? And like I said earlier, a lot of sponsors, if they see a lot of potential in a relationship, they'll work with you, right? And so, but again, 25,000 in one deal, that's your only investment ever. Probably not worth it, because you gotta, now you gotta extend taxes, you gotta deal with the K1. Maybe you have some other expense on your accounting, things like that, right? So, yeah.
Awesome.
Can I add real quick to that? Which is, I've had investors, they have a friend or a family member, and they would combine their funds together to come up with that minimum amount. So they could form a single member LLC or multi-member LLC in this case. And that LLC would come in as a single investor into the deal. So you could pull your money, 10K each, 20K each, whatever that is. to come up with the 50K if that's the minimum investment. Just an idea to throw out there.
Yeah, that's a great idea. I'm glad you brought that up.
Now, we've been talking a lot when it comes to more of like the theory aspect. I'd love to get a little bit more practical. And so now with Alvin, I'm very curious, you could go back to when you just started. What advice would you give yourself about real estate investing? Because, many of the people in the audience are new investors, professionals, busy engineers, and they are looking to potentially get investing.
Yeah, I would say so. From a practical standpoint, one of the first things I did was just compare what are my options, and that's part of the knowledge in reading books and accrual of a baseline, right? So I have my retirement accounts, my 401ks, all of that where I get my company match, so that's great, free money. I'll take free money, but I don't putting anything above that is really just locking up my money for 40 years, which I don't know if that sounds too good, right? So, other options of taking the funds, just getting the tax over with. Now I'm able to diversify into different asset classes like real estate, to where now I can maximize the all of the different ways that real estate pays you. So for me, I didn't. I had an equity account as well that was in the stock market. I had it for since 2015, and it a lot of people think they're getting 8, 10, 20% in the stock market. You're really not. I mean, honestly, statistically, the average investor only makes 3 to 4%. The average person in the stock markets makes 3 to 4%. Guess what inflation is? 3 to 4%. So you're really breaking even at the end of the day. So I withdrew my equity account. I'm like, okay, this I was getting like 5%, 5, 6% in my account. I'm like, this is not working. I took that out, and I joined masterminds, went to meetups, went to conferences. I just networked within the industry, whatever, real estate specifically. You can go to business meetings, meetups, investor meetups to see what people are doing. And then from there, I actually invested as a limited partner and collaborated as a general partner with other investors that I know, like, and trust, like made that connection with. I see they take uh, advising and managing people's money seriously, and they have great assets to back it up. And from there, I kind of just grew and evolved over the years. But initially, you know, see your options, analyze your options, make sure you have a good plan laid out, and then you can grow and evolve from there.
Yeah, I'd love to get your perspective.
Yeah, I'd say that as an investor, or really anybody, everybody has some sort of competitive advantage in something, and you need to figure out what is your specific competitive advantage. Um, or in other words, how can you add value to somebody else and really leverage that? For me, my position, it was really capital. Like I lived in Boston, expensive market, not great for investing. Didn't have a lot of extra time. Was on a bunch of projects, and it was 10 to 11-hour days when I first started out. But what I did have is I had a little bit of extra cash that I could invest, and um, people forget that that's an advantage. Like a lot of people that are in real estate that are hustling to be active sponsors. Uh, nobody here, but like when you're starting out, a lot of them don't have extra cash, and they have to be very creative with how they structure these deals. Um, but that might not be your advantage, right? Your advantage should be geographical. Like maybe you're in a location, maybe you have knowledge in a location where it's favorable to buy real estate. And you can go and you can take that value and bring it to somebody like who I was 3 years ago. The guy living in Boston or New York that would would love to be, partnered with you on a deal where you can be his boots on the ground. Um, maybe your competitive advantage is you don't mind living in a multifamily and uh, you don't realize that a lot of people don't want to do that, right? Like they don't want to go and house pack because they're in the family, they already like where they live. They don't want to self manage. That's a real competitive advantage. That's you. Then then go and do that, right? And and once you figure out what that competitive advantage is, uh, you got to go for it. I think with engineers especially, you get caught in these loops of analysis paralysis. I know I was, where I did my homework. I really knew my stuff. I analyzed the deals, but I would get to the last second and I just couldn't hit the button to make the investment happen. Right. And it took me a long time to get over that. Um, and there's really no good, another way to frame that. The way I framed it was, I looked at it like tuition. We've all gone to school for something. We've all probably paid a lot of money for college. Um, what's 30, 40, 50 grand? That's your grad school. Nobody has a problem going to grad school, but they won't spend that on an investment where they're going to learn just as much. Right. So, figure out how to frame it where once you figure out your advantage, once you know what you want, just go and do it.
Yeah, definitely. When you talk about the engineering, uh, think of engineers. There's tolerances, and those tolerances have tolerances. And even if that tolerance fails, there's still another built-in tolerance. So the same way how you're looking at deals, it's like, hey, I need to make sure this is right. And what about this? And what about this? And you're never actually taking the actions. It's about taking action. And finally, Sandhya, I would love to hear from you. What practical advice would you give to yourself, for example, when you were beginning?
Always understand what you're getting into. So whether that's a stock market, any other asset class, understand what are the risks and therefore the rewards. So decide if that matches your risk tolerance. So do your homework, skip the steps, and learn as much as you can by shadowing people, following people, reading those monthly reports, asking for questions, etc. Whether that's your, quarterly report on a stock you invested in, and what is that company doing? How is it positioned in the market, etc. Whether that's Amazon or something else, as well as, is it going to be, what are some external influences that could be out of your control that could affect it? Like in the case of real estate, it's usually weather related. It's related. It's claims. A lot of those things get thrown up. So understand the risks. And the biggest thing I would say for real estate is that it is illiquid. Some assets cash flow better than the others, but if a storm hits and they have to do repairs, they're going to put all the money into those repairs first before those units can be rented and you can start cash flowing again. So understand the risks and rewards associated with any investment and do all the homework that meets your risk tolerance, but set a deadline. Because if you don't set a deadline a year from, you'll still be in the same place, thinking, analyzing, especially engineers. We have analysis paralysis. Until it's perfect, we're never going to do it. And so you got to at some point take the plunge. It's never going to be a perfect time. And so make sure you understand the illiquid side of real estate and the volatility if it's the stock.
And
Awesome. Hey,
I'll
continue
say
on,
one.
man.
I'll say one other thing to add to that. Engineers are definitely known for analysis paralysis. There's actually a study that says basically that once you get 80% of the required knowledge, you've reached the point of optimum performance. So like spending an extra month to get maybe 5% or 10% more knowledge, you actually reach the point of diminishing returns. So I definitely want to, for all us engineers, you don't have to know every single thing perfectly. At Just know a good amount, and you'll be good.
No, thanks for all of those great answers. Now, I really wanted to open it up to the audience. So, open it up to the audience for any questions that they personally have. Those could be, you can put that within the chat, or if you'd like to ask that live, you can feel free to do so as well. And also, if you would to remain connected with us about what we're doing here at Opportunity Partners, you can follow us on Instagram, LinkedIn, and at the QR code, you're able to learn more about how you can potentially get started, set up a call with us, and we actually have a free a free multifamily guide, which is about a 10-page guide, which really discusses about the different aspects of multifamily investing, the different terms, and also there's a case study, which can give an example of, hey, if someone had invested 50,000, for example, or 100,000, what are kind of the potential returns and how the financing structures work. But yeah, with that, we'll open it up to questions. And if you want to ask live, you can raise your hand and we'll let you in, or you can put the questions within the chat.
So we do have one question already. Bon, I'm going to allow your mic now if you want to ask it live.
Mom might be shy.
He might be shy, but his question's in the chat, so I can start with that one. So essentially, it seems like it's a good question on overall business plans. So as you're doing these syndications, do you have 3 to 5 year exits where you pay out your limited partners and investors? So I guess to the panelists as a whole, how do you decide on your business plans? Are they specific to properties, or do you tend to go for one specific approach?
For me, it varies by property because some might be a bigger value add and some might be more of a yield play. By that, I mean the extensive rehab I might have to do with one property is a lot more than another one. So then the cash flow might be a little bit slower on the extensive deep value add. Might be 6 months before you see any cash flow after the deal closes versus another deal where we might start cash flowing right away, right from, the first quarter. So it depends by deal. The other big thing is, what is your investor appetite? So I always poll my investors on a regular basis. And if their needs change, and let's say they're saying no more 60s properties, no more 70s properties, etc., then accordingly, I also tweak accordingly and go with the kind of deals that they appetite for, because without investors, there is no deal, at least in my case.
Yeah, I mean, for me, it varies as well. I'm on the syndication multifamily side, so that's typically 5 to 10 years, but I also do a lot of short-term um, funds or investments for investors as well on a 6 or 12 month or even 18-month basis. So those are typically smaller, of course, 10 and below units where we can get a quicker turnaround. Of course, if it's a 50 unit or 100 plus unit, you can't really implement a value add strategy within that 1 to 2 year time frame. So those will be a little bit longer, but it definitely will depend on the deal. And so having those options, depending on what the investor is looking for, we can strategically place them where needed.
Yeah, and my approach is a little bit different than the other panelists. So I don't operate real estate. I always partner with an operator. I focus on raising money, and how I do that is through what's called a fund of funds model. So in selecting deals and making sure that they're right for my investors, like the other panelists said, it really depends on the deal and the asset class. Certain deals are better for generating cash flow. Other deals are better for growing wealth over the long term. I try to have, 2-ish offerings at the same time that can kind of appeal to different investors.
I see one more raised.
Yeah, Daryl has his hand raised. Hey, Brandon, did you give him access?
Yep. So it looks like he has access. Daryl, do you want to try and unmute? If not, while we wait, I think it's a good question in our chat here. So obviously now the interest rates have risen. Construction costs are now exceeding the cost to buy used. So I guess, how have the economic challenges really affected your ability to acquire and sell the properties, and the value add strategy? Is there a return still in making those modifications?
I have only done value add, at least light value add. I haven't done just or yield play where I buy, do nothing, and it cash flows because the pricing has been adjusted accordingly. By the time we buy it, I've got to at least increase the rent some before I can cash flow back to my investors. But I don't do any new construction at all. So the nice thing about the older properties I buy, Class B and Class C, which is, 80s, kind of properties, those tend to not have increase in supply. Because if a brand new building goes next door, that's a different market. That's a different go into that apartment than my resident who comes to my 80s property. So we haven't been affected as much by the competition. I don't know if that fully answers the question as far as yield play versus value add and vintage of property. But yeah, we haven't been affected by new development construction costs. But in terms of our value add strategies where we have construction to do, we try to find vendors who can be direct suppliers who buy things like, flooring in large containers. So we get that kind of supply for the number of rehab units we have. So we always negotiate contracts as well as vendors because those two things will keep our costs down. So at least on a quarterly basis, review all your suppliers, vendors, and contracts.
Yeah, I
And
mean,
those,
I would definitely piggyback off of that. You can offset a lot of the market fluctuations just on how you buy, getting a great deal, and the value add component to increase the sale price, the equity into the property, so that you can not have to worry about so much of the cap rates or the interest rates. Of course, they still will be a play at hand, but it won't affect you as much as another investor or operator that aren't doing as much into the deal.
another question here related to understanding the different mistakes that we've potentially made. So, mistakes are often, this is from Monka, mistakes are often good learning experiences. Can the panelists speak to any mistakes they've made and what they learned from it?
Yeah, I mean, I can kick it off. So, by my second LP investment, which is still playing out, I did know a lot about what I was getting into, and thankfully the operator has done a great job despite all the economic headwinds that we're facing. But for instance, I didn't know that I was investing in like a fund of funds that was investing into the deal, so there was like a dual layer to that, more fees and whatnot. I didn't know what floating rate debt was. I didn't know what debt service coverage ratio was. I um, I kind of just got sold on like the pretty pictures of the place, the dog park, yeah, the playground, whatnot. Because like as a new investor, it's really, really hard to know all these things that go into a syndication. And especially if there's a layer of private equity, which, all these deals, they are private equity, but if there's like another layer, like I just said, which is very common in real estate investing, in private placements. So, I just didn't know what I didn't know. And the thing that saved that deal, and will, again, still playing out, but we'll probably save it um, is just working with operating partners that, even despite all of these headwinds in the economy that are like causing a lot of distress, um, they're they're just they're very invested themselves in this deal and making sure it goes right. They really care about their reputation. So I think like working with people that have something to lose, whether it's money, reputation, ideally both, that's always a good insurance policy. But for me, that was one of the mistakes. It's just not really fully understanding what I was investing in.
Yeah,
Anyone
that's
else have any big relevant mistakes they want to share?
I would say the one of the biggest and most important mistakes that you can make is just, as TJ alluded to, not knowing the operator and their involvement in the deal. I mean, uh, it's basically you can take a great operator, sponsor, and it can make an average deal go perform really well. Whereas you could take a great deal and just lay it out on the red carpet, and then, not having a trustworthy or knowledgeable operator or general partner, they can drive it into the ground. So really, really making that connection, understanding who you're working with, who you're investing with, As TJ mentioned, them having skin in the game and uh, what they gave up to work in their current deal, like how much are they involved in it, goes a long way to help you out from a knowledge standpoint. 'Cause at the end of the day, the only real risk is just your lack of understanding or asking the right questions, right? You, mentioned the don't know what you don't know, but the best way to get around that don't know what you don't know is by asking questions. The more questions you can ask and get answered clearly, the better off you'll be.
I can add to that as well as far as mistakes go on the passive investing side. I did not check and know on a regular basis the history of the operator. And because of that, I found them having some pretty unscrupulous practices, such as charging their car payments, self payment, et cetera, to the deal. And because they had a construction company, they decided to do a huge amount of rehab in 2020 when we had COVID strike, and we were all concerned about the cash flow and whether tenants can pay or not. He spent a ton of money because it was profiting his construction company when everything was shut down. So that was a mistake. I don't think our values were aligned, and I'll never make that mistake again. On the operations side, I think that no matter how much money you keep in reserves, I would say keep more. So make sure the operators, the main team members who are going to be managing the deal after closes till the end, till they ride it into the sunset and return your money, make sure they are liquid, really highly liquid operators, because it's wonderful to have youngsters get into this business, really love that. But they usually don't have much money. So even if a storm hits your property and 10 units are down, they don't have the liquidity to pay for it. And vendors will want to get right away. You might have bridge deals, et cetera. So liquidity of the team and how much they're willing to put into this deal, because they might be liquid for one deal, but not have it enough for a dozen deals. So those are both important to me. And boots on the ground. Never invest in a deal if somebody's not local, because you'll be paying for all their travels.
Yeah, I'll echo that as well. You don't want to invest an operator or a sponsor that doesn't have personal funds. Because if things go sideways, you want the operator that is going to throw another 100 grand into the deal to kind of keep things liquid, do everything they can before they come back to you and ask you for money. It sounds like Sandy's learned that lesson. I've also come across that more on the operator side. And thankfully I've worked with people where we're willing to throw more money into a deal that goes sideways. And as an investor, that's probably top of my list or close to it. Like how liquid are you as an operator? And if things go sideways, what are you going to do about it? Are you going to ask me for more money, or are you going to put your own funds into the deal at a very low or 0% interest rate in order to make sure things go well?
So another question here is from Okena and Sandhya. I'll ask this to you specifically. What are methods you use to utilize to acquire funding for deals if you don't have the needed money on hand, whether that's leveraging debt / loans, essentially? I would love to answer that from a passive investor perspective and active.
So as a passive investor, if I don't have money, I'm not going to borrow money to invest in a deal, but I've always relied on my retirement funds from a prior employer, like I said, because I am not counting on that money anytime soon. So it sits well for real estate, which can be illiquid for a while. On the active side, if I have personal funds, I've never had personal funds to buy large multifamily. The smallest deal I've bought is almost $7 million. So 70 to 80% of that comes from the lender, depending on the time that you acquired it. Back in the day, they would loan us between 75 to 80%. Now it's more like 60 to 65%. So the remaining money that you need for a down payment and possibly any rehabs, that comes as raising money from individual investors. So build a network of investors who want to put money in real estate, but don't want to do the work. That's like your busy professional, as an example, or people like me who still put money from their retirement funds into deals because that's money they can't use in their own deals. And that's how you build a database, 25 or 50K at a time. It adds up, 100 investors, you're at, $2.5 to $5 million, depending on how many of them invest with you. So raising capital doesn't happen overnight. You have to establish a track record. It's a slow process, but if you stick the course, it does happen.
Then there was a follow-up question to that, and I love it. TJ, you can give kind of your perspective on that, where how do you all identify your ideal deals? Do you search independently? Do you use an agent, online group?
I think you're muted, TJ.
Thank you. Yeah. In terms of what I focus on, that's honestly not my area of expertise. Like I said earlier, I always work with somebody, and usually the person I work with, they're bringing that part of the expertise. They're the deal finders. I can speak to what they do and what works for them. Honestly, if I had to summarize it, it's a whole bunch of marketing. It's marketing. It's developing relationships with the people in real estate in the market, and then it's consistency. Consistently checking in with that person and keeping your lead warm. But I'm honestly interested to hear what Alvin and Sandy have to say about that, because they're more focused on deal finding.
I mean, I would say for me is the relationships is huge. A lot of my deals is from either broker dealers or bank relations, foreclosures or just distressed properties in general. I have not as much focused on the marketing side, getting direct sellers, but from a relationship standpoint, I mean, it's a relationship business. Teamwork make the dream work, as the saying goes. So you're gonna have different people in different areas doing their different specialty or niche. So it's the same thing on the deal acquisition side, the same thing on the funding side. You got to know how to relate and connect and be able to work with people to where they'll send you deals.
Pretty much the same thing. Like I am going to be trying to sell some deals in the next year or two. And the first thing I look for as a seller is somebody who has a prior history of doing these large acquisitions, because my deals tend to be in the range of 15, 20 million and up. So usually it's relationships with the local brokers, because I'm in a large market in Dallas, Fort Worth, and a large. So if I was a seller, I'm not going to just try to direct sell to somebody. I'm not going to wholesale it. I'm going to go through the official listing broker who awarded it to me in the first place to make sure they get their commission, and that way they'll award me the next deal. That's how it works. But if I needed to kind of get a feel for the market, I might off market it before doing the full blown marketing of brochures, tours, listings, call for offers, and all of that. But either way, deals are done by your network. Usually we want to give business to the brokers. However, the deal is more likely to get awarded if you have a prior relationship with the seller. That can't hurt, right? So if I know two people coming to me, both have history of closing the same size deals, I'm probably going to give it to the person I know personally rather than the stranger. So relationships are always important. So brokers list all the deals here, or you can get on their mailing list even for off-market deals. And so connect with them and they will their list, and I define a little box because I have a very specific criteria. But the major brokers in Dallas are Marcus and Millichap, CBRE, Northmark is a big one, Gray Steel, etc., Greya. Those are some of the big brokers in this area.
Okay, perfect. Yeah, looks thank you guys all for feedback. I feel like there are panelists. I want to make sure that I respect your time. We're about 10 minutes over. So if people would like to still stay and discuss, that is perfectly fine. But I want to thank you again for Sandhya, TJ, and Alvin for coming on today. And as I initially mentioned, if there are others who are wanting to learn more about multifamily and kind of get more of a practical perspective, please make sure to follow Sandhya, TJ, and Alvin. I'll send a follow-up email with their medias. And at the same time, you can get our free guide here at Shady Partner, where we talk about the overall aspects of multifamily, kind of get into more practical perspective, and you're able to go through a case study. And as Sandhya put her info there, you can connect with her on LinkedIn. But in the meantime, if you do still have other questions, I'll still be on here. and the rest of us in the puppetry and this team will be here. So yeah, thank you all again so much.
Thank you so much
Thank,
for the opportunity and good luck to everyone in their real estate journey.
thank you. Thank you. It's been a pleasure.
Okay, thank you.
Hey, Ende, it looked like the microphone is working now, man.
Okay, yeah, you can ask your question, man.
Yeah. No, I put it in. I kind of put part of it in the chat. No, first of all, there's the theory, and then there's the application. There's a math model and there's reality. I mean, you all guys are really doing it. You put a lot of stuff out there, and I think the challenge is in pulling it all together, right? As an engineer, I'm analytical. I even spent time in financial services full time at one point, and that was many, many years ago. And now I'm at a place to where I have a lot of knowledge, man. But just to get good, competent CPAs, accountants, and folks to really want to partner with you, it's been difficult for me. So I guess I'm really interested in some better ways and knowing how to, identify some good, solid support folks. I mean, there is I think Sandhya mentioned something about using retirement funds. She mentioned Roth IRAs. And so she mentioned other custodial accounts, right? So how do you reconcile pre-tax versus post-tax money, right? I mean, I definitely, there's a lot of things I can do with some rollover funds that I have, but the idea seems kind of frightening, right? Given that currently is all pre-tax money. So any ideas on the better ways to identify the supporting financial service folks, to help keep you out of trouble? And then secondly, what are some of the big rocks around, using retirement funds to try to do deals?
Satan, first of all, just say that I am not and none of us are financial professionals. So
Right.
definitely discuss with your CPA or good professional on any type of advice, please.
Disclaimer first.
Yeah, I'm not going to give tax advice here, but as far as like building a team, with, for instance, I'll just get out of the list, like financial planner. Well, like we said, most financial planners aren't going to recommend real estate because they don't make any money off of real estate. So that might, for me, we actually had a financial planner. My wife had one since she was younger, and we fired him because he wasn't very helpful. I think you can almost be these people for yourself, or you need a little bit of competency in each. And it sounds like you already have that.
Yeah, there.
You're there. Yeah. So, like accountant, I would find somebody that knows real estate. You don't have to find somebody that's doing all, crazy sorts of fund management stuff and whatnot. You're starting out. Me personally, I just got a CPA that's very hyper focused on like fund management, and I just started paying for an advisory service. It's not cheap, but after a while it makes sense. But when you're starting out, you don't need to again, not tax advice, but you don't need to get like the person that uh, that knows all the ins and outs, right? So that'd be my advice is if you feel like you're there, and it sounds like you kind of said, you feel like you're there, you have a lot of knowledge. Um, Maybe don't like, if you're second guessing yourself, just trust yourself and know that you have the knowledge to go in and make it happen. I think you did mention too, like it's overwhelming, all this information that's out there. And I agree with you. You go on Instagram, you go on LinkedIn, everybody's talking about a different strategy. Someone short-term rentals and long-term rental, house hacking, and syndications, cards. It really doesn't matter what you pick. It really doesn't matter as long as you just pick one and you just stick with that. It's very easy to get shiny object syndrome and to go off in a bunch of different directions. To try and look at this market and then that market and then short-term rentals over here. I did that for a while and it sent me back. So that'd be my advice, is just to pick one that you think you have some advantages in, and then just ignore everything else.
Yeah, that's solid. I mean, I really do have a conservative approach, like asset allocation. my approach would be kind of passive, not actively managed, not expecting a crazy return, but also being able to sleep like a baby at night and not deal with, all the hassle. I put a big chunk into a Vanguard REIT, right? It's down 3% now, but I do know that it's, overall it's a solid play. But with corporate debt, reset looming on the horizon, for a lot of corporate real estate, that can be a little unnerving, but still, I believe that real estate has a place, and I'm interested and will in fact keep researching until I can, find some plays that work for, me and the missus.
Yeah, I mean, we're all working on stuff too, so feel free to reach out to all of us directly. You mentioned your situation. I have investors that are similar. Actually, a lot of my investors are extremely conservative. They don't really care so much about how much they're going to make as much as that they're not going to lose their money. Right? So there are options for that. Something that comes to mind is investing in private credit right now. I kind of alluded to it, but it's all real estate backed, but instead of being the person taking out the loan, and buying the property, you're the bank, and you're lending money to that person. And if they default, then you're collecting on that asset, and you're usually getting it at a pretty steep discount. So, I guess it's worth too thinking about things like that. It all fits under the real estate umbrella.
Yeah, I mean, I would say definitely reach out to us. You make in real estate, you make your money on the purchase. So the more you can get a better deal, the more you can uh, just mitigate a lot of that risk from the get go. The better off you'll be. The least likely the market will affect you. As I was mentioning earlier. So, I mean, personally, just me personally, I don't really like to go too large in my investments, like with the REITs, et cetera, because those aren't nimble vehicles, especially when the market fluctuates a lot. I want to be in something where I have a little bit more control and a little bit more knowledge of things being more nimble to move and adjust accordingly. So a lot of my investments are very much so, like I mentioned, foreclosures, high value add to where it's secured by the real estate. So you're never going to go to zero. And at the same time, there's a lot more cushion and profit to tap into, regardless of what the market is doing. Like for example, right now I'm actually closed on a foreclosure that we got it for 1.2 million, and the after repair value is 3.1 million. That will all be within 12 months. So with the renovation budget, we have $1 million in equity that we're creating within 12 months. So you can mitigate a lot of risk just by that nimbleness.
And I'm sure you have the right tax and accounting folks that make sure that those are real gains, right?
Oh yeah, oh yeah, yeah. That so one other quick comment I want to say: there's a difference between average returns and actual returns. Like you can actually have a higher average return but make less money
Hmm.
than another portfolio with a lower average return, but actually has more money. So like just little things like that to understand and distinguish to put yourself in the most optimized financial aspect, the most optimized financial state. So a genuine self-assessment of your financial makeup and where you want to be will help you a lot.
Well, I certainly appreciate it. I do want to pull a little closer, to what y'all got going on, and I appreciate it.
Hey,
Absolutely.
yeah, Daryl, thanks so much for your question. And yeah, we'll definitely stay connected and feel able to assist. With with that, I thank everyone for being able to come today and have used this time last 5 minutes. Anyone would like to please shout out where they're coming from. We can use this more as a networking session. Thank you again to the panelists for being able to come on today. And again, if you do have any further questions, I would love to know more. Feel free to reach out. Definitely, you can get our ebook at engineers.invest.com. I think I'll let Collins to put that into the chat. You'll be able to get that. We also have a podcast where you're able to learn more about what is going on and set up then reach out directly and set up a call with the QR code. But yeah, with that, you guys all for coming, and we can rest of this 5 minutes is if you have any other questions or just wanted to introduce yourself, talk about where you're coming from and what your experience is, and do that.
I got to drop now, guys, but it's
All
been a
right.
pleasure. Thanks so much.
I'm out. Peace.
Good to see your faces again, and I'm sure we'll catch up soon.
For sure, for sure. Yeah, connect on LinkedIn,
Right.
LinkedIn with any questions. We can certainly answer those.
Right. Thanks, TJ. Thanks, Alvin.
All right, have a good one.
Thanks everyone for joining.